Chapter 15 is on investments. So one thing I want you to wrap your mind around is that companies can be investors too. So up until this point, we've been talking about individuals investing in a company either by buying stock in the company, and how do we account for that on the company side, or individuals being bondholders and getting paid interest for their investment. So we in Chapter 14 talked about notes payable and bonds payable. We pay interest as a company, and then we have to pay this back. We pay our creditors back. And so the company can issue a bond, we give the bondholder a contract, and the bondholder gives us money. Well, on the company side, a company can actually be a bondholder. So in this situation, the company would be buying the debt of other companies. So when we buy a debt investment, this is an asset, and we will be the ones receiving the income, and then when it's paid back, we'll have a gain or a loss. And then in Chapter 13, we talked about investors buying stock in our company. So we would issue either common or preferred stock, and we would pay those investors dividends, and then if we wanted to buy it back, it'd be treasury stock. Well, we as companies can also, so the company issues the stock certificate to the stockholder gives money to the company. Well, we as a company can be a stockholder of other companies. So when we do this, we will purchase the stock of another company, and then it is now an asset on our books. We, the company, will receive the dividend income, and when we sell it, we have a gain or a loss. So I want you to put on your investor hat in Chapter 15. You already know a lot of this terminology. It's just now we're on the other side of the transaction or investment. So there's 3 classifications of investments that you're going to need to know. Trading securities. This can be either a debt or equity investment. And this is if we're holding our investment for less than 3 months. We're going to record this investment at its fair value. The second type is available for sale securities. This can be debt or equity. And we're going to put this as kind of like a catch-all category. If it's more than 3 months holding period, then we're going to record it at fair value. The last category is held to maturity. And this is for debt only because stock doesn't have a maturity date. So we're going to hold this debt or these bonds or notes until the maturity date, and we're going to record them at amortized cost. Now, amortized cost is really the same thing as carrying amount. So that's how we're going to record our investments as well. Okay, so let's start with debt investments. Here's an example. Okay, so we have a bond that was issued at face value. This is another company issued a bond, and we want to buy it. And it pays 6% interest twice a year. So the first thing I want you to be able to do is to calculate how much is this interest going to pay, how much is the interest this bond is paying. Well, we'll take $18,000 times 6%, that's $1,080 per year. We want to know semi-annual payments, so we're going to divide that by 2. Then our payments twice a year are going to be $540. So I drew a little timeline up here. I think it will help you see what we're doing is that twice a year we're going to get $540. Well, what's quite common is that a company will have a day they ide the bond, but not everybody runs to like the doorstep of this company and buys it on the issue date. It'll buy it sometime after the issue date. So let's say our company buys this bond on February 15th. So what's interesting is that on this day, July 1st, we're going to get all $540. But we didn't own the bond for the first 45 days of this 6-month payment. So this is when we purchased it. We're still going to get all $540, but 45 days of that is not really ours. We didn't really earn it. So let's find out how much 540 days is. So we take 18,000 times the 6%, that's that 1,080, and we're going to divide that by our 360 days in the year. That's $3 a day. Well, 45 days of interest is $135. So we didn't actually earn $135 of the 540. So what we have to do as purchasers of this investment is we have to pay for it. So we're going to buy an $18,000 bond, put it on our books as an asset. We now own this investment in this bond. We also have to pay $135 of accrued interest that we didn't actually earn. So the total purchase price of this investment is going to be the face amount plus the accrued interest that we will get paid on July 1st. So on July 1st, we're going to get the $540. Notice now that we're the investor, and so the cash is a debit this time because we are the ones receiving the cash. In Chapter 14, we were the ones paying the cash. Now we're the company buying the investment. So we get all $540. That's $540 of cash, but $135 of that is not really ours. So the remaining $405 is what we earned. So together that's $540. This investment receivable really acted as a holding place for when we were going to receive the whole amount, but we didn't really earn it. So the only amount that ends up in revenue is the amount we earned, which is the time period that we actually owed the bond. Let's look at another example. Okay, so here's a $200,000 bond. It pays 6% interest, and we have $2,000 of accrued interest in this bond. So when you see accrued interest, that's the amount of interest that has built up before the payment, before we bought it. So that's going to be the receivable portion. How much is the payment, though? So if this is a $200,000 bond that pays 6%, and I believe this is semi-annually, we're going to take $200,000 times 6% is $12,000, and divided by 2 is $6,000. So these are semi-annual payments. Okay, so that means our payment is $6,000. So we're going to buy these bonds. Here's your purchase entry. Be an investment on our books of $200,000. And we have an accrued amount of $2,000 that we're going to have to put in that holding place interest receivable. So the total purchase price of this bond is $202. Now we're going to receive that payment on the payment date and remove the accrued interest. So the revenue that we recognize on the first payment, so this is just the first payment, will be $4,000. Any future payments, all $6,000 will be interest revenue. But just this first payment has this accrued interest built up. So what happens if we sell the bond? Well, this has two steps. We first want to figure out when we sell a bond, what's the carrying amount, and then what's the gain or loss. So to figure out what's the carrying amount, we look to the amount that is in the investment account. So that's the amount in our investment account right now. And we don't have a discount or premium situation here. So we don't have to worry about any amortization. This was sold at face value. So $18,000 is our carrying amount. Now proceeds is what did we sell this for? Well, we sold an $18,000 bond. We sold it at 98. Okay, so it was purchased at face value, so 100 essentially, and sold at 98. So put in your calculator 0.98 times 18,000. We got cash of 17,640 for this bond. So our loss is the difference. So we got cash of 17,640, but we paid 18,000 for it. So we got less for it when we sold it than we paid for it. So that's a loss. And when you record that entry, you're going to record the proceeds as the cash amount you got, and you're going to remove the face value of your investment, 18,000. And the difference is going to be 360. And to remember, a rule of thumb, since the loss is on the debit side, or the missing amount of our entry is on the debit side, that's also another way you can figure out it's a loss. If it had been on the credit side, it would have been a gain. Let's look at another example. Okay, so we have Alliance Corporation here. We have a $50,000 bond, $2,000 of accrued interest. It pays 12%. Well, first thing I like to do is figure out how much is our payment. Well, if we have a $50,000 bond and it pays 12%, that should be $6,000 a year. Divided by 2 is $3,000, assuming these are semi-annual payments. So our payment is $3,000. All right, let's record our purchase. So we purchased the bond for $50,000, and we had some accrued interest that we have to pay up front for, $52,000. And then we're essentially going to be getting it back in our first payment of $3,000, removing the interest receivable of $2,000. So revenue on our first payment is $1,000. Let's say we then sold $40,000 of that bond at 103. Well, we didn't sell all $50,000. We only sold $40,000 of it. So $40,000 is our carrying amount. And 40,000 times 1.03 equals 41,200 of proceeds. So we received cash of 41,200. We only paid 40,000 for it. That's going to be a gain of 1,200. So you can record the proceeds as your cash, remove the bond, just the $40,000 that you sold. You still have $10,000 of bonds left as an asset in your investments. And then the gain is going to be the difference. Notice we had a difference in our journal entry here on the credit side, and that's a gain. Okay, so those are some of the basics of debt investments. So if we have investing in bonds of another company, now let's talk about equity investments. So this is where a company is going to be buying the stock of another company. The company that is buying the stock of the other company is called the investor. And the company that is getting invested in, so the company that has the stock that's being purchased, is called the investee. So let's say that the investee, the company we're looking at buying a stock in, has 1,000,000 shares outstanding. And we, company A, want to be the investor in that company. We're going to buy $100,000 of stock, or 100,000 shares of their stock. Well, what I want you to be able to do is figure out what percentage owner are we. This is going to be really important when we're looking at equity investments, is to know how much we own of the company. So to figure that out, you're going to take the number of shares we own, or that we're going to buy, divided by the total outstanding shares of that company. So in this situation, we're buying 100,000 of this company's 1 million outstanding shares. So that makes us a 10% owner. Okay? So when we're looking at ownership, how we record our equity investments depends on how much control we have. So if we have less than 20% ownership, we have essentially no control. So if that's the case, we're going to use the cost method to record our investment in that company, which means anytime we get dividends, we're going to record them in income. If we have 20 to 50% ownership in a company, we're considered to have significant influence. And so if that's the case, we're going to use the equity method. We will record these investments a little different. We're going to record our percentage of the company's net income as a whole. And then anytime we get dividends, it's going to reduce our investment. So this is different from the cost method, which is why you need to know how much ownership you have in the company. And then if you have more than 50% control or 50% ownership, you have control in this company, and we will use the equity method. Now the equity method is just like above, that I showed you above, so we're going to use the equity method, but then we're also going to consolidate our financial statements with this company. So we would take our company and financials and their company financials, and we would put them together. Now this is an advanced accounting skill, so we won't be going over consolidated financial statements in this class, but we will be focusing on the 20% and the 20 to 50% levels, okay? So let's start with the cost method. This is where you own less than 20% of a company. So anytime you purchase stock in another company, I want you to remember the purchase price is going to be the amount of the investment plus commissions and fees. So here's an example of what I mean. We have Birch Company. We're going to purchase 2,000 shares of Axe Company. So Birch is the investor, Axe is the investee. And we're going to purchase it at $49.90 a share, and there's a $200 commission. So let's calculate what's the purchase price of this investment. The first thing you want to do is say $49.90 times the 2,000 shares. That is $99,800, and then you're going to add the commission. So the purchase price of this investment is $100,000. Okay, so then what's the true per share amount after we've added in the commission? Well, you take the $100,000 divided by the number of shares we bought. This was really $50 per share once you factor in the commission. So here's how we record it using the cost method. So this is the cost method because we own less than 20% of this company. We're going to record investment as an asset on our books for $100,000, and we're going to pay cash of $100,000. Notice our investment that sits as an asset, that includes that commission price we added. Now, because we're using the cost method, let's talk about dividends. Let's say Axe declares a 40-cent per share dividend. First, let's calculate how much dividend do we get. Well, we will own 2,000 shares. For every share we own, we get 40 cents. So that means we get $800 of a dividend. So that's how much cash we get. $800 is our debit. And we're going to take this straight to income. So dividend revenue is going to hit the income statement. And that's going to affect our net income of our company. That'll increase our net income. Now let's see what happens when we sell our stock. Okay, so let's say we sell 1,500 of our 2,000 shares, and we sell them for $54.50. When you sell a stock, you subtract the commission from the proceeds. So let me see, how much are our proceeds? Well, we have 1,500 shares that we sold for $54.50. So that's $81,750. Now we're going to subtract, because we're selling this time, subtract the commissions. We actually won't get to keep that cash. We have to pay commission. And so that works out to be $81,590. That's our proceeds. Okay? And then our carrying amount is not that $100,000. That's because that $100,000 is actually for 2,000 shares. So here we figured out with the commission, we paid $50 per share for all 2,000. So if we're going to only sell 1,500, then 1,500 times 50 is 75,000. So that's our carrying amount because we still own 500 shares, which is that other $25,000. So the proceeds of 81 minus the 75 is going to be a gain of 65.90. Okay? So let's do a couple more questions here. Like if we owned if we're going to purchase 100 shares of Saxton Company for $45 each, and there's a $280 brokerage fee. Let's see, what would that entry be? Well, we're going to purchase 100 shares times $45 plus 280 of commissions. So we're going to pay $47.80 for this. So you're going to debit the investment and credit cash. It's really just going to take some practice getting used to adding the brokerage fee when we buy and subtracting the brokerage fee when we sell. Okay, so here's a question. Let's say we have a company that has 17,000 shares. That's how much we own. Of an investee that has 70,000 shares outstanding. How much of this company do we own? Well, 24% if you put that in your calculator. So if we have a company, in this case, we would use the equity method because it's more than 20% but less than 50. Okay? So if we have a situation like that where we're going to own a company more than 20% less than 50, we got to use the equity method. So one thing I want to be clear here on what's going on is what's happening with the equity on the investee side. So here's the company, that's the investment. So here's the investee. And inside that company, they're going to be keeping track of their equity just like we've been doing since Principles of Accounting 1. We start with beginning equity, we add net income, we subtract withdrawals to get ending equity. So let's say this investee had a beginning equity of $300,000. And this company has net income of $105,000. And they paid dividends of $45,000, so we're going to subtract those. So their ending equity is going to be $360,000. Okay. Well, we, the investor, using the equity method, we're going to mirror this process over on our side, on our books. So our beginning investment, if we're purchasing, let's say we paid $100,000 for 40%, okay? And so if we are a 40% owner, then we get 40% of the net income and we get 40% of the dividends. So we're going to add it. 40% of net income is actually $42,000. So we're going to add net income. And we're going to subtract 40% of the dividends, which works out to be $18,000. So our ending investment is essentially mirroring the equity over here of the big company in our investment account. So our ending investment should be $105,000. $124,000. And we'll do this, we'll add this into our books at the end of every year. So here's how it works. We're going to purchase investee company A. So we're going to pay $100,000 for this investment. So we're going to put $100,000 in our investment account, which is an asset. And then at the end of the year, so like 12/31, we go, okay, company A, how much money did you make in net income? And let's say they made this $105,000 of net income for the year. So we get $42,000 of that. So we're going to add that to our investment. And the other side of that entry is going to hit an account called income in investee. That's going to hit the income statement and increase our company's net income. Also on 12/31, we get a dividend, and we actually get this cash. So that's $18,000. They send us a check. So we're not going to hit dividend revenue this time like we did in the cost method. We're going to remove it from our investment, just like we do up here. We're subtracting it from our investment account, so it reduces our investment. So that now you'll see if we do a T account, we started off with a $100,000 investment, and we added $42,000 for net income, and we took out $18,000 because we received a dividend. And basically, we added all $42,000 here, but then we got some of it in cash. That's how come we're subtracting it. And then our new investment account should have a $124,000 balance in it, which agrees to what we anticipated would happen up here. Now, one little thing you want to make sure of is that when your company has a loss, this still works the same way. So investee over here would start with beginning equity, subtract a net loss. Instead of adding net income, we would subtract a net loss, subtract dividends, and then you have your ending equity. Well, on the investment side, we would just subtract our percentage of net loss instead of adding net income, and it works out to be the same. So let's say we have a company that we own 45% of, and they have a $20,000 loss. So you basically are just reversing our entry above just because it's a loss. So $20,000 times 45% is $9,000. So your net loss entry would really look like the reverse of the net income entry above. Okay, so that is chapter 15, and I'll put some practice for you to do before you do your homework, and let me know if you have any questions.